What's really going to happen to our property markets now that the unemployment rate is so low? Unemployment fell to a 48-year low at 3.5% when 88,400 people found work last month in Australia's increasingly tight labour market. In fact, it's now got one job seeker for every job advertised at present. But while some may see this as a good thing, the stunning June jobs data all but guarantees that the Reserve Bank is going to lift interest rates by, well, at least 0.5% again in August, and some economists are tipping a 0.75% increase. Now, this has caused the Financial Review to run a headline saying this will be a knockout blow for our housing markets. Now, I don't agree with these forecasts. In today's Property Insider video, Dr. Andrew Wilson explains what happened to our property markets in the past, which should give some background to the forecast he's going to make for where property values are going to end up at the end of 2022. Considering his track record, Andrew Wilson, Chief Economist of My Housing Market, is somebody worth listening to. Hi, Andrew.
Yes, hello, Michael. And it's a real good news, bad news story environment, isn't it?
The commentators are out there telling us how bad things are going to get. But let's look back in the past so we can get an idea of what's going on. How bad have property falls actually been?
Well, history is our first port of call if we're doing research in terms of forecasting anything, and particularly house prices. If we go back in time and we look at the record falls over a year in house prices, the highest national fall, and that's from December quarter to December quarter recorded in the modern era, and that's since 1987, was 5.5%. And that was in 2018, Michael, where we had similar circumstances, a fear campaign, which was sidelining buyers and sellers and impacting confidence. And the highest result we've had on a state basis was 9.9% in Sydney over a calendar year, and that also was in 2018. But of course, some of these predictions cover the peak to trough scenarios. When we look at peak to trough declines in our housing markets, and that's from the peak of the market cycle to where it finally bottoms out. The record peak to trough on a capital city basis, Michael, was between June 2017 and June 2019. So that's a 2-year period. Sydney house prices fell by 18.2% over that 2-year period. So that averaged around 9% per year. Melbourne, its record peak to trough decline was between March 2018 and June 2019, and that was a 14.1% decline. The other major capitals, Brisbane's record peak to trough decline was 7% between June 2010, September 2011. Over a similar period, Adelaide's record decline in house prices peak to trough was just 4.5%. And for Perth, its record peak to trough decline was 8.4% between December 2008 and March 2009. So these numbers certainly are not anywhere near some of the forecasts on an annual basis that have been made. This is the historical evidence for us. It remains to be seen whether, once again, those that are predicting the Armageddon of house price falls will once again prove to be incorrect.
But Andrew, the market's very different at the moment. At those times, we had credit squeezes, we had other economic issues. At the moment, our economy is doing well. Everyone who wants a job's got a job. There are no forced sales. There are no mortgagee sales. So what do you see moving forward in 2022-23?
Well, certainly we have a crisis of confidence evolving, which is what we saw in 2018-19. But these things tend to be short-lived, Michael, when people get on with the business of moving house, bigger house, smaller house, move to the beach, move to the bush. And those factors eventually overcome the fear factor. We have a shortage of rental property, which is clearly evident with skyrocketing rents and very low vacancy rates. So that attracts particularly investors to the market. We've got all that demand yet to come through from first home buyers through the extension of the first home buyer deposit scheme. Of course, we're opening borders, so migrants and students coming back into Australia need somewhere to live in an undersupplied full employment economy. Other supporting factors, such as the government welfare handouts announced prior to the election, record savings. We've got a great position in terms of our assets. We've got a couple of predictions here in terms of where I believe our house prices will find themselves by the end of the year, Michael. Melbourne and Sydney, no surprise, will be the outliers, in my opinion. I think both Melbourne and Sydney will record around about 6% falls in their median house prices over 2022. Of course, they'll still be well ahead of where they were 3 years ago. Sydney would be up still 30%, Melbourne up 20% compared to prices in 2020. I think Brisbane's on track to record 11% increase in the median house price this year. Adelaide up 12%. Perth, which is having quite a sustained revival in its market, I think house prices in Perth will be 9% higher. And if we use a weighted average on all those major capitals, I think we'll end up, the national house price will be just above the line with growth of around about 1% over this year. So still well short of a lot of those predictions, Michael. Got to understand, Melbourne and Sydney have had an extraordinary period of growth over the last 3 years. They're still well ahead of the mark, even with those projected declines in prices. With all those positives in terms of demand over supply, eventually the fear factor will lose its edge. That's what we saw in 2019, Michael. Even though we had a lot of bad news stories around early in 2019, prospect of tax changes for investors, the Royal Commission into the banking sector, and of course the same hysterical headlines regarding house price crashes at that time. But buyers started to work their way back into the market because they started to, recognise that there were good value opportunities as a result of buyers and sellers lacking confidence to be in the market. And gradually the market turned early in 2019, even before we had those interest rate cuts at the back end of 2019. So fear tends to be a short-term or shorter-term driver of housing market activity.
Of course, it's got to be remembered there's not one Melbourne or one Sydney property market. High-end properties that led the boom are now coming off the top. So overall, while the Sydney and Melbourne market is going to drop around 6%, some sectors will drop more and others are going to hold steady, aren't they?
Well, that's right, Michael. Our data is clearly showing that the middle and higher ends of the market are the ones that are leading prices downwards in Melbourne and Sydney. The budget markets are holding up, and of course that's because they're driven by first home buyers and investors. And as they have particular incentives to be into the market, first home buyers with the first home buyer deposit scheme, where there are limited places, and of course investors are chasing those relatively high yields with these very tight rental markets that we have.
Well, it'll be interesting to see how things move moving forward, because the Reserve Bank's being caught by surprise in a number of ways. Inflation's higher than they expected. Unemployment is much lower than they predicted only a couple of months ago. So they're going to have to be on their game, and we'll be back each week to report and commentate on what's happening in the market. Look forward to catching up next week.
Yeah, thanks a lot.